It's time for Yahoo Finance's Market Minute. Stocks edging higher as investors anticipate clarity on how the Fed views inflation and growth risks. Meta is the final Mag 7 pillar to fall, its recent decline erasing all of its year-to-date gains. Meantime, Cathie Wood's ARK Investment Management cutting its stake in Meta for the first time this year. Shares of the tech giant lower today. Nvidia in the green today after falling more than 3% on Tuesday. Analysts saying they feel comfortable about long-term AI demand after CEO Jensen Huang's keynote at the developer conference. Still, the investor response somewhat tepid after the GTC speech. And General Mills here shares lower on a sales miss and downbeat outlook. The company behind some of your favorite cereal brands saying inventory headwinds and a slowdown in snack sales weighed on its third quarter. That's your Yahoo Finance Market Minute. For more on what's trending, scan the QR code to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup, we're going to discuss why the recent weakness in tech stocks might be an opportunity for you to cash in on. And some Americans are getting one-time payments or bumps in their Social Security benefits. We'll break it down with Yahoo Finance's Carrie Hannon and reveal if you qualify. Plus, it's Travel Week on Wealth. Ahead of the spring and summer travel seasons, we're bringing retirees the financial strategies for travel in your golden years today. But first, let's take a look at some of the market action here. 90 minutes into the trading day, stocks right now rising. This is ahead of the Fed's rate decision due out 2 p.m. Eastern Time. Of course, we're going to hear more from Fed Chair Jay Powell as he takes the lectern and gives us some more commentary in the press conference at 2:30 p.m. But before that, joining me now, we've got David Wagner, who is the Aptus Capital Advisors portfolio manager. David, good to see you. We've been seeing a pullback in tech over the last several weeks here, Meta becoming the final Magnificent Seven stock to turn negative for the year. We're keeping tabs on it to see if it can get back into positive territory here today. But you say this weakness overall among the Mag 7 is breeding opportunity. Why is that?
Brad, love seeing you, man. Love talking to you, but you're exactly correct here. I think we all know that the S&P 500 has now pulled back 10% from its February 19th high, but a lot of market participants feel like that pullback is much worse than that 10% because a lot of people are very much over leveraged or over allocated to this Mag 7 area. So we've seen a lot of these names pull back, 15, 17, 18%. But as you pointed out, I think this volatility breeds opportunity to actually get back into these names right now because I think they have such a long runway for growth moving forward into the future. I mean, look what Jensen just said yesterday at the GTC keynote speaker. Like this data center opportunity could be a $1 trillion opportunity by 2028. Yet CapEx spending for 2025 is only expected to be at $313 billion. So you can see almost a 3x CapEx spend that really goes to the revenue of a lot of these companies within the Mag 7 area. And Brett, as we talk about many times on this show, these Mag 7, I love them right now. It's hard for me to say that because I am a small cap portfolio manager at heart. But these 7 stocks, even Tesla a little bit, they have that characteristic of operating leverage where they can really see some top line revenue growth that really makes their bottom line explode higher at a much greater clip.
That is a remarkable point that you made as well, David. I mean, even your small cap heart is now looking at this dip and saying, okay, you can't really avoid an opportunity like this. So what type of diversification should people still be balancing their portfolio with, even if there is this outsized opportunity?
No, great. Another great question there. And that's also me saying I like the Magnificent Seven on their pullback. When small caps, my bailiwick, my love of my life, it's also pulled back, almost 17%. So what I would do right now, Brad, is probably 2 things. I love the barbell approach. I love barbelling the mega caps that have this characteristic of operating leverage. But I also like owning some higher quality small cap stocks that are very much depressed in valuation. I think you can diversify your portfolio by owning small cap value because if you think of that antiquated tic-tac-toe board that Morningstar uses, like The S&P 500 is in your top right now, large growth. And there's no better way to hedge your portfolio by going on the opposite spectrum of that tic-tac-toe board of owning small value. So I think if you can own some quality small value, I think it's a great pair with owning your mega cap tech stocks. And the second reason, and the second thing I think that you can do to kind of hedge your portfolio if you expect to see, I guess, a little bit more volatility on the downside, especially as we, go up against that April 2nd tariff deadline. I think you can own some long puts within a few different active ETFs out there that are not handcuffed to the calendar, they're not calendar constrained, that are very much active underneath the hood of the active ETF itself that owns these long puts.
Okay, want to get to some of your picks, and then we'll pivot perhaps to discussing the Fed and, of course, the decision coming later today. But first, some of the other areas of opportunity that you're looking across right now. One of them happens to be a Mag 7 name in Amazon, but you have two non-Mag 7s in there, in United Healthcare, and then you've also got Copart. Why those?
Yeah, Brad, I think we'll start with the Amazon. And I think the most simplest way of saying this is in two facets. Amazon's cheaper than Walmart right now. I own both stocks in my concentrated portfolio, but when was the last time we saw Amazon trade at a valuation relative to Walmart that was cheaper? And then you couple that with the aspect that Amazon is one of the best companies that highlights the operating leverage within the Magnificent Seven, especially on the retail side and on their cloud side. So I think the valuation is very palatable right now to own Amazon. If you look at the other side of the spectrum, I also like owning healthcare right now. Healthcare, historically speaking, has been one of the worst performing sectors during presidential election years. And that's exactly what we saw in 2024. But now that we're in 2025, we recognize that healthcare tends to be one of the best performers coming out of this presidential election cycle. And one of the biggest beneficiaries, I think, there would be UNH. It trades at a pretty hefty discount to the S&P 500 by about 20%, putting it at almost one of the largest valuation spreads versus the S&P 500 ever. And I think a lot of the headline risk is overblown. The fundamentals remain. So I like UNH. But the third stock that I like here, Brad, is a little bit differentiated. It's kind of an unknown name. And obviously, with all the jargon and headline risk around tariffs, I tend to skew a little bit lower down to the market cap spectrum where you can get some more domestic exposure. And Copart is one of the coolest stocks that doesn't have any tariff risk, that has a long runway for growth. It operates in an oligopolistic type of market with its only peer being IAA. But as bad as it is to say this in an altruistic as I want to say this, Brad, like Copart's the best way to play texting and driving because they're basically an auction for salvage cars, and they kind of have their hands in the pockets of a lot of these different insurance companies where they can get these salvage cars. And I think the best statistic to say here is if you go back 10 years ago, of all the cars that were in accidents, about maybe 12% of them were considered, totaled. Fast forward to today with all the bells and the whistles and the electronics, it's closer to almost 23% of cars that get in accidents are considered total. And the biggest beneficiary of that is going to be Copart. And they trade at a reasonable valuation.
All right, well, I would imagine Copart would hate to see a full self-driving coming because that is anticipated to cut down on some of those accidents. David, thanks so much for taking the time here with us today.
Thanks, Brad.
It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Williams-Sonoma falling after earnings. The retailer missing on its full year outlook for operating margins. That miss overshadowing a top and bottom line beat in the fourth quarter. Comp sales rising 3.1% versus an estimate of a more than 1.5% drop. The company does see full year net revenue in the range of negative 1.5% to positive 1.5%. The retailer is boosting its quarterly dividend to 66 cents a share from 57 cents a share. Next up, Tesla getting an upgrade to buy at Cantor Fitzgerald. The analyst maintaining a price target of $425 a share, 89% upside from the stock's last close. Now the stock is down more than 40% this year, and Cantor Fitzgerald says that makes an attractive entry point for investors due to upcoming catalysts like autonomous taxi services. And finally, Etsy. That was initiated with a neutral rating at JP Morgan. The price target set to $50 a share, implying 12% upside from the stock's last close. The analyst says Etsy is facing macro headwinds in competition, and the firm is looking for more favorable macro and consistent executive to drive improved performance here. Shares flat just barely to the upside during today's session. Nvidia CEO Jensen Huang's keynote address at the company's GTC conference touted the company's role in helping artificial intelligence grow, saying the tech is at an inflection point.
AI is going through an inflection point. It has become more useful because it's smarter, it can reason. It is more used. You can tell it's more used because whenever you go to ChatGPT these days, it seems like you have to wait longer and longer and longer, which is a good thing. It says a lot of people are using it with great effect.
Here with more on how investors can approach AI is Dan Newman, who is the Futurum CEO. Dan, good to have you back here on the program with us. Did this keynote change anything for AI?
I don't know that it changed anything for AI, Brad, but I think it changed the perception of Nvidia and its role in the long term of AI. People stood in line, waited hours to get inside to see this keynote to basically determine, is Nvidia going to be the stock to own for the next 5 years? And is there competition coming? Do they have another moat? Can they expand their business into the enterprise? And I think Jensen did a good job of addressing all of those things. But the way the stock continues to move, continues to make everyone sort of question, are we at an inflection of the AI trade? Jensen said we're at an inflection of AI. I think the macro headwinds, the tariff war has basically created this pause in AI investment, but I think they're wrong. And I think Jensen did put that to bed yesterday, but there are a few caveats.
And so how do you recommend investors approach AI investing right now?
Yeah, I think the thing that a lot of investors have to stay away from is this urge to trade AI. And what do I mean by that? Basically, right now, we're going to see these kind of massive swings of volatility, but they're not based on AI demand. We've seen numbers between $500 billion and $1 trillion of AI chips are going to be required over the next 5 years, Brett. And with that kind of growth of AI chip demand, what we're going to see is growth in network, growth in the fabrication foundry side of the business. We're going to see growth in consumption, so that's applications. And of course, these Mag 7 players that we're kind of talking about being a bit down and out, these are going to be the number one place where consumers and enterprises are going to turn to utilize cloud, utilize AI. So if you think about that opportunity and you're not kind of looking at the quarter or the month or the day, that sort of gambling feel that trading can have at times, I think now is the place to enter a lot of these positions. Remember, there was these pictures of people, lining around the corner, these great memes, Brad, of people waiting around the corner to buy Nvidia at 140, 150. Now it's 120. Why would you not enter now? Nothing has fundamentally changed except the roadmap has gotten more compelling.
And so as we're thinking about this, earlier this week, Google, they announced some plans to buy cloud security firm Wiz in its largest ever acquisition. Why do you see this as a test, perhaps, of the Trump administration and ultimately what deal-making could look like?
Yeah, I'm really glad you brought that up. I put out a tweet and I basically said something like 95% chance that this does not close. And a lot of people came back surprised that I said that. First of all, I just want to say I love the tie-up. I genuinely believe that multi-cloud security is going to be the future and that this the connective tissue between Google and Wiz would be great for the business. Having said that, we just haven't tested M&A of this size in the Trump administration. A lot of people thought as soon as Trump got elected, we'd see this boom in M&A, but we really haven't. And I think it's been the uncertainty of the tariffs. But look, we've got new FTC leadership. They haven't really come out and said very clearly whether or not they're going to be supportive of deals of this size. We know there's still some concerns about kind of the ad business. And then we know that there was still some interest in breaking up Google. And I just wonder if trying to push a $30 billion deal through at this time is going to land. Having said that, from a technology standpoint, I think this is great. And I still think Google's oversold. I think it's got a massive AI opportunity. So as an investor, I still think it's an interesting opportunity here, but I'm worried because we just have no proof that a deal of this size, and we've seen Juniper. Juniper's been all holed up with HPE, and that's a smaller deal. Google as a Mag 7, I just think it's going to get a lot of attention, and not just US, but worldwide.
Dan, thanks so much for taking the time here with us. Dan Newman, Futurum CEO. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. It's been a tough year for the housing market. Americans have been buckling under the weight of high home prices, high mortgage rates, and low, albeit improving, supply levels. Redfin recently reported home price growth in February clocked in at the slowest pace since July of 2024. And on an annual basis, it was the slowest pace since August of 2023. So while there are signs of improvement on the affordability front, we are still dealing with a 30-year fixed-rate mortgage above 6.6%. Today, we saw mortgage applications declined 6.2% from the week earlier, according to the Mortgage Bankers Association. Here to react, we've got Vishal Garg, who's the CEO of online mortgage lender Better. Better also reported fourth quarter earnings yesterday. Vishal, thanks so much for taking the time here with us. Just want to get your overall kind of just health of the housing market as you're looking through some of the data points here that we just rattled through.
I think the overall health of the housing market is pretty challenged. We still have rates above 6.5%. We've got low inventory. We've got consumers concerned about tariffs. But overall, we're still seeing massive growth here at Better.com. Last quarter, we grew our volume 77% compared to the year before. We grew our home equity volume over 400% compared to the year before. And a lot of that has been driven by our application of AI in every part of the mortgage process to make home ownership cheaper, faster, easier for our customers. And so I think, again, people are still out there buying homes, but they're looking for value, they're looking for speed, they're looking for certainty in an uncertain world. What
are the anticipations and how pivotal this spring buying season could be to really set the tone for the rest of the year, as affordability still is one of the biggest concerns for many home buyers that are trying to make sure that whether they're going existing home or new home, that they've got the ability to kind of offset some of the higher pricing that they're navigating through. And I'll add bidding wars if we do see even more bidders come into the market.
I think there's a lot of headwinds, but I do think there are a couple of tailwinds. One, I think, the new administration has signaled their intent to really get the 10-year Treasury yield down, which is what drives the 30-year mortgage rate. And I think if we can do that and we can show that, you might see consumers say, fine, I'll deal with a 6.5% rate now, and I'll be able to refinance it at 5.5% or 4.5% at a later time. Look, mortgage rates are most likely to come down, but rents are still likely to keep going up. And so if you can afford to rent the place you love, you're just paying your landlord's mortgage. So I would recommend consumers jump into the housing market while things are a little uncertain, while you can still get discounts on houses compared to last year or the year before, and really, lean into the fact that if we have tariffs, cost of home building is going to go up. And so if you can find a home that's already built today, and you can get in front of potential refinance that might come a year or 2 years down the road, I think a lot of consumers are going to plunge into the market this year.
What is the likelihood of the 10-year actually coming down? Because that's not something that's specifically within the administration's control. So then how should that also kind of permeate into the buyer's mentality and real expectations?
Yeah, I think there's two things that the administration controls with respect to the 10-year. I think one, we've had quantitative tightening keep going, and I think the Fed could lower quantitative tightening without affecting actual interest rates. The other thing is that because of the uncertainty out there, mortgage spreads, which is the spread of the mortgage rate compared to the 10-year Treasury rate, are kind of at near all-time highs. And so you could see mortgage rates come down by 100 basis points or 1% per year just by tightening the mortgage spreads between the 10-year and the 30-year. And a lot of that is just a function of whether the U.S. Treasury is involved in buying MBS or not. And so I think there's a lot of really interesting ways to get mortgage rates down without interest rates having to come down.
Okay, it sounds like there are a few things that have to happen in order for that to take place. Based on the data that we've been continuing to share with our viewers week over week from Freddie Mac, one of the more optimistic tones that they've been able to, and that they have struck over recent weeks, is just in the outlook and looking specifically at mortgage rates continuing to be relatively low versus the last few months. And I guess That is the larger portion of this because it's a relative basis that a lot of potential buyers might be looking at here and trying to figure out when they should be timing the market. How much of an uptick in demand do you think that could signal if buyers are just thinking about this on a relative basis versus a longer term basis?
That's a really great point. This time last year, consumers were looking at 7% rates. In the middle of the year, the rates went as high as 8%. And so you're looking at consumer psychology having adjusted to a 7 to 8% rate environment, and 6.5 starts to look really good. Overall, we have seen demand. One of the ways we can forecast demand is the number of people coming to get pre-approved to buy a home on better.com. And that demand has spiked in the past couple of months. The number of pre-approvals we're processing is quite huge. On top of that, we talked about it on our earnings calls. We have over 2 million people that we have pre-approved in the past couple of years, and we're starting to see them come back to the site, change their pre-approval letters, starting to see them come back to the site, put in a new property that they might want to buy. And I think that's a great leading indicator for people coming back into the market, dipping their toes into the market now that rates are below 7%.
What is the credit worthiness of you're seeing right now for those who are pre-approved versus historical standards? Because we know that there's been a near-term concern about what the credit worthiness for so many who are trying to get into the housing market is looking like.
I think the consumer credit has actually held really stable. And so credit scores have actually held completely stable versus where they were a year, 2 years, 3 years ago. I think what we have seen instead is debt to income ratios change. And so at Better, our average debt to income ratio was around 32% for our customer base getting pre-approved. And now I think it's trending up to around 35%. I think, we saw in the broader market as a whole, the percentage of mortgages that are over 43% debt to income ratio has increased dramatically as affordability products have become necessary for a large percentage of consumers who are shopping in the market. And so we've been broadening our product criteria and broadening the types of loans that we do on our platform via our AI underwriting. And that has helped fuel a lot of our growth.
Vishal, thanks so much for taking the time here, giving us the assessment of the housing market.
Thank you so much for having me on.
Certainly. Sticking with housing, mortgage applications declined 6.2% from the week prior, according to the Mortgage Bankers Association. Here to put that data in context and explain what it means for the housing market, we've got Yahoo Finance's Danny Romero. Hey, Danny.
Mortgage demand pulled back last week due to interest rates and the economic uncertainty, which is rattling the housing market. Mortgage Bankers Association reported that total mortgage application volume dropped 6.2% from the previous week. And mortgage applications to purchase a home were flat, but they were 6% higher than the same week a year ago. So there is a lot of inventory out there, and mortgage rates still remain steady around that 6.6%. And so that could be a supportive dynamic as we enter this spring selling season. Separately, Wells Fargo's economists say that mortgage rates will remain elevated. They are expecting that mortgage rates will be around 6.9% at year end. So that means that affordability could be still challenged at the end of the year.
Danny, there's a new report from Realtor.com today that says fewer multifamily permits today could mean costlier rents ahead. So kind of put this in context for us.
So what's happening in the rental market is that apartment hunters caught a break in February as rents continue to move downward. So data from Realtor.com shows that rents dropped to $1,691 last month. This marks the 19th consecutive month of year-over-year decline. So remember, rents have been trending downward for well over a year and a half since the pandemic run-up. But renters are still paying a lot more than they used to be. There is a catalyst that is really important to factor into this rental market. Construction for apartments has pulled back since last year, so we could see rents push higher. I think when we take a look at this Realtor.com data, I think it's still unknown how much we will see, but we have seen this pullback in construction. So if there's not a lot of inventory in the future, yes, where's the demand going to go, right? So it's still, I think, a wait and see to see what could happen, but we are already seeing it in the data that there is not a lot of inventory for multifamily. Now, we're not talking about single family.
Certainly. Danny, thanks so much for breaking down some of the data. Appreciate it. Coming up, everyone, 2 changes coming to Social Security and how women investors can build confidence as they're set to inherit a larger piece of the financial pie in the Great Wealth Transfer. Stay tuned. Over 3 million Social Security recipients affected by the Social Security Fairness Act will experience some changes to their benefits, starting with a lump sum payment by the end of the month. Here with more is Yahoo Finance's own Carrie Hannon. Carrie, who should be expecting that lump sum payment?
Yeah, Brad, it's complicated, but this is aimed at public sector workers such as firefighters or police officers, teachers who had a pension, who have a pension with the government, and they also had Social Security benefits from they had a part-time summer job or what have you, where they were paying into Social Security on that income stream, and it sort of makes right the fact that they were their Social Security benefit was reduced because of having that pension, the way that the math went. So it impacts people who are retirees, who are surviving spouses or spouses of people in this category. So as you mentioned, around 3 million people. And what will happen is there'll be a retroactive payment for a lump sum that for 2024 that will hit accounts by the end of this month. And the government, you will get a Social Security Administration will send a letter talking about this and explaining it. It'll go to the bank account that they have for you. And then moving forward, starting on the April check, there'll be a bump up in what that Social Security payment is each month. So this is a good thing, but again, it's a little bit complicated, but it could be up to $1,000. But it really depends on, the type of social security benefit you're talking about and so forth, and when you retired, those kinds of things.
And so, according to the memo, the Trump administration will now require seniors to verify their identity in person or online rather than by phone. How should seniors prepare for that change?
Yeah, Brad, this is actually a really big deal, and it's going to impact a lot of seniors. The point here is now you used to be able to verify your identity on the telephone. If you had an issue with your Social Security payment, you wanted to initiate, starting, getting your benefits, so forth. And now, if you don't have access to doing it online, which is the way they want you to do it with a My Social Security account, then you need to actually go into an office. Now, if you live in a rural area, you are miles and miles away from a Social Security administrative office. In addition to that, many seniors don't have internet access. They live in a rural area that doesn't even have that, or they're not tech savvy, or they have a disability of some sort. This is going to impact a lot of people, especially with them talking about shuttering offices around the country. So this is something we're going to see some pushback on, I believe. But right now they say you need to show up in person, you need to have a driver's license or a passport or some sort of government state ID that verifies who you are, and you have to show up in person, make that appointment, and go actually into the office.
All right, some really valuable tips there. Thanks for breaking this down for us, Carrie. Really appreciate it.
Thanks, Brad.
Women are expected to control a greater piece of the financial pie in the coming years. McKinsey estimates women will control $34 trillion, roughly 38% of investable assets by 2030. That's up from just over $7 trillion a decade ago. And while the number of women investing in the stock market is growing, 71% according to Fidelity, up from 60% in 2023, they don't necessarily see themselves as investors. 38% consider themselves an investor versus 52% of men, and 49% of women saying they are comfortable with their investing knowledge versus 62% of men. 58% of women say investing intimidates them, according to the survey, compared to 45% of men. So let's dive into some of the things that my next guest says all women should know about money. We've got Carrie Carbonaro, who is the certified financial planner and author of the book Women and Wealth, on set here with us. Carrie, great to see you.
Thank you for having me. So great to be here, Brad.
Absolutely. We just ran through some of those stats. Let's start with investing. Where are we seeing even more of the knowledge set expand and really be embraced among what is going to be a massive kind of wealth generation moment for women?
Yes, it's a wave. That's what I call it. It's a wealth management wave.
I like that.
And so what's going to happen is women are going to control 2/3 of the nation's wealth, which is actually the same amount as the GDP of the United States, which is absolutely incredible. This is 5 short years away. And the numbers, if you go out even further, Cerulli just came out with, by 2048, it's going to be 54 trillion. So these numbers are just big and growing. So women really need to know what to do with their money, and women are really comfortable with, my clients are comfortable with putting their values into their investing. So women like to tie their portfolio to what they believe in. And also, I know that the confidence score of women feeling not confident about investing. Women really need to be educated and empowered. And really, that's the missing link. I actually just came from a breakfast with women, and a whole bunch of them who are really high wage earners. And they were asking me questions from what is a Roth to what is the best way I should invest for my child. And like just the basics that most women just don't know. They don't know where to get the information from. So I always say every woman should be taking care of their own financial health, not when it's time for a crisis. So usually as a CFP, I get hired from women when something terrible happens, a death, a divorce, a disability, a job loss. And so that's a vulnerable time. I want women to wake up on a regular day and say, I would like to work with a financial planner, and I would like to get my financial house in order, and I would like to hire a CFP.
And so you talk about some of those major life transitions. Even before the life transitions, how do you go about knowing that you've got all of these different assets and you want to understand what they're worth to you, how you can make them grow and work for you over time as well?
So I was actually just talking about this. You know, I think a lot of women don't even understand the different buckets. And so what I was saying to them is, you know, there's a tax-free bucket. There's an after-tax bucket, there's a tax-deferred bucket, and then there's real estate. And I put them all in separate buckets. And you should know what's in what and why, and how to invest it from there. So like, it's very interesting. And another thing that I did for women, because there's a lot of sports analogies when it comes to wealth, right? And so because it's an industry that was created by men for men, and women were kind of an afterthought, and now guess what? We're gonna be the primary clients of all wealth management firms within the next, decade. And so one of the things I did was I actually did a comparison of shoes to asset classes. And what was so interesting on it is I got so much feedback from women saying, I've never understood it like this. Nobody ever explained it to me like this. And then from guys I understand shoes now.
Oh my goodness. Well, I mean, that's really talking about the way to reframe the discussions as well and make it more relatable. And so as you're thinking about, and I hate to ask the question of the biggest mistakes that you see people make, but perhaps the biggest opportunities for improvement that you're hearing from some of your clients.
Yes, well, so let me go back to, so with women, because we have a lot of different challenges that men don't have. So for example, we have the pay wage gap, we've got the wealth gap, we've got the out of workforce for caregiving that men don't have. Then we have the longevity issue, then we have the confidence issue, and then we have the not as aggressive issue with the management of our investments. A lot of my clients feel more comfortable in cash, and I have to get them over that hump to not be in cash because you're not keeping pace with inflation, and you need it to grow because of all these issues I just said, right? So I believe that women we have all these strikes, right? So, but we are going to have all this money. So women are going to have to be invested for the long term. So it's all about education of the different asset classes and the different placement and the tax placement of where it should go. And there's so many women out there that just don't know where to go, don't know who to trust. So I always say, find somebody who's a fiduciary and somebody who is giving you advice in your best interest, because you want to make sure that you're not being sold products. Women don't like to be sold. They like to be it's like a decision. It's like a group decision with a woman. They want to know that they're making the right decision with their money. And sometimes it's analysis paralysis because you can't give them too much information because then it's just too much and it's overwhelming. Like, women don't really love that whole beating the S&P 500. They like to know, what is this money going to do for me? How is this going to tie to a goal? What is this going to mean for my life? Right. Can I run out of money? Am I going to be homeless? Am I going to be, can I afford a second house? Are my children going to be okay? All these things are like life goals that are important to women, more so than, am I beating the S&P 500? Does it resonate?
And the money has to stretch longer because you also tend to live longer as well.
Yes.
Carrie, thanks so much for taking the time here with us.
You're welcome.
Coming up, how AI is transforming the labor market. I talked to an expert about how software engineering jobs are being impacted by new technology. That's next on Wealth. EU regulators are continuing their crackdown on big tech with actions against Apple and Alphabet. Under new rules, Apple must let rival makers of devices like smartwatches and headsets access its tech and operating systems. That will make it easier for third-party devices to connect to Apple products, as well as develop their own alternatives to Apple features like AirDrop and AirPlay. The EU Commission says the rules will lead to better choices for consumers and ensure a level playing field for tech companies in Europe. Apple slammed the decision in a statement to Reuters, calling it bad for its products and its users. And Alphabet's Google was hit with 2 charges of breaking landmark EU rules. The rules here, as regulators are accusing the search giant of preferential treatment in its search and Google Play products. If it's found guilty in this case, the company faces fines of as much as 10% of its global annual sales. President Trump has threatened additional tariffs over the EU's crackdown on U.S. tech, claiming it amounts to overseas extortion. The CEO of AI startup Anthropic says within a year, AI could write the majority of code, overtaking software developers, and workers are worried. According to a recent survey from Pew Research Center, over half of U.S. workers are worried about the impact AI will have on their workplace. So, how can workers future-proof their careers? Joining me now, we've got Sophie Novati, who is the co-founder and CEO of Formation, a virtual fellowship program for software engineers. Great to have you on the program here with us. Just first and foremost, as we think about AI's impact on hiring, especially for tech roles, how are you seeing this play out, and how can employees potentially kind of offset some of those concerns?
Hi, Brad. Thanks for having me on today. It is definitely a very exciting and interesting time to be in the tech industry. We are definitely seeing AI really transform the landscape, both in terms of the products and the innovations that it's driving, as well as the role of the software engineer. And what's happening right now is that as engineers are increasingly embedding AI as an intrinsic part of their day-to-day workflow, it is really reducing and even automating in some cases a lot of their work. And as AI is taking some of the repetitive portions of their role, it is opening up these engineers to focus on higher level strategy and work. And this is kind of contributing to a trend where companies are increasingly looking to senior engineers who are needed to really define the system architecture and translating business and product needs into technical specifications, and ensuring that AI generated code is meeting the quality and the security and performance expectations of the product. And what it looks like day to day is, a ton of new tooling. So engineers are now having to work alongside AI-powered coding tools like, Copilot and Cursor. And instead of writing code from scratch, they are really having to evaluate the code that is being produced by AI and ensuring that it meets those expectations. There's an increased need for engineers who have product sense. Engineers are having to be able to understand business needs and product strategy in order to make decisions in the code base that are compatible with those goals. Yeah.
And so within that, Sophie, I wonder what skills specifically are employers still looking for in a more AI-assisted or AI as a coworker landscape and environment in the future?
Yeah, well, so the first thing is really just, as AI is making engineering more, coding more efficient, engineers are just expected to do more with less, right? As a lot of these LLMs, as you're working with them, as you type a few characters, it is getting really good at predicting what you need to the rest of that line of code. And so really engineers are really being amplified and being able to produce the same amount of work output in 50% of the time, right? And this might sound scary to some engineers, but as AI is taking the heavy lifting of coding, soft skills actually become much more important within engineering, where engineering, it becomes more about the collaborative exercise of communicating and translating those non-technical business needs into a technical specification and working collaboratively with, data scientists, product managers, designers, to integrate those models into real world applications.
And so all of these things in mind, is there going to be a future where there are specific certifications that are required or even education modules that companies can roll out to their existing workforce and their existing teams in order to equip them with the proper tools to prompt AI and put in the correct queries so that they're getting the output that is also necessary?
So I would say there's kind of two tiers of engineering when it comes to working with AI. So at the first level, it is really just product engineering, which is building all of, formation partners with Waymo, and of course, there's a huge team of engineers at Waymo that is working on their core, autonomous driving technology, right? And those are all of the ML engineers, AI-focused engineers, big data specialists, engineers like that. And then once that technology exists, there's a whole product layer that is required for consumers to be able to interact with that technology, right? From the little device at the top of the vehicle that is communicating with other pedestrians. There's the mobile app that consumers use to hail these taxis, and so on. And so there are skills that are needed for engineers that are working alongside AI, not directly on the technology, and there's also skills that are needed directly to build the machine learning models that power the underlying technology. And so the types of skills that are needed are also different for these different roles. And so, for just the standard engineer, to build some of these skills, you really need to get yourself into the right roles in these times where you're able to be close to that technology. And if you're interested in building some of that underlying, machine learning, you probably also want to start building some AI literacy.
Yeah.
There's a lot of courses out there that, teach you the foundations of it, and really just immerse yourself in the AI landscape. Like every single day, there is changes that are fundamentally.
Oh, we're watching it. Yeah. We're watching those changes play out in real time. Sophie, we got to leave the conversation there as we're heading up against the commercial break. We certainly do appreciate the time here.
Thanks, Brad, for having me on.
Coming up, should recent market volatility derail travel plans for retirees? I speak to an advisor about this next on Wealth. More older adults plan to travel this year. 70% of those aged 50 and up are planning trips. That's up from 65% in 2024, according to AARP. They expect to take about 3.6 trips total in 2025, going at least 50 miles from home for 2 days or more. For those who are near or in retirement, could the recent market volatility shake up some of those vacation plans? That's the big question. Joining me now, we've got Josh Jelinski. He is the CEO and Chief Investment Officer at Jelinski Advisory Group and author of the book, Retirement Reality Check. Josh, great to have you here. What do you recommend to retirees who may be spooked by some of the recent market volatility and considering canceling that upcoming trip?
Well, I don't think you should cancel it. We talk about in my book, Retirement Reality Check, and on my podcast, The Financial Quarterback, how to spend, live, and give without regret. So your financial plan should be set up so that you don't have regrets when you die, which means take that extra vacation. Now, if you don't have money saved up, you shouldn't be going. You need an emergency fund of 6 months in the bank. And you should also have what I call a volatility buffer. That's 1 to 3 years in cold, hard cash. That way, you can tap that when we are experiencing the volatility like we're experiencing now with the Trump tariff tantrum, as I call it.
So how does travel fit into a retiree's budget?
I think it should be a critical component of your budget. If, maybe 10, 20%, I mean, you should be planning 2 or 3 trips a year. What is the day that you spend the most during the week when you're working? And I ask that question to everybody, and they say Saturday or Sunday or Friday night when you're off, right? So you should be designing your retirement plan as if every day is a Saturday. You don't want to have to, go back to work because you can't take that trip to Alaska. I meet with too many couples and retirees and help them with their money. And when I meet them and have the good fortune of helping them steward their finances for 20 years, 10 years, the biggest hurt is that when they have regrets, I didn't take that trip with the kids. I didn't take that trip with my wife. They don't say, I wish I had another $10,000 in my 401k.
Certainly. So what accounts, with regard to those accounts, what account should retirees be pulling money from to pay for travel?
Number one, your taxable accounts. Those are already taxed monies. High yield savings accounts, CDs, bank accounts, then your tax deferred accounts, and then your Roths. You really want to grow your Roths for the future because they grow tax-free. And you only really want to take out the IRAs and 401ks when you need to when you turn 73, unless you have some type of strategic Roth conversion plan or something like that.
Some really great advice and tips for planning that travel, even if you are in retirement, and especially if you're in retirement, I should say. Josh, thanks so much for joining us here on the show.
Thank you.
Let's do a final check of the markets here as we are pressing up against the 12 noon marker. Taking a look at the Dow Jones Industrial Average, that's higher by 0.8%. S&P 500 up 0.9%. The Nasdaq Composite, that's up 1.25% here on the day, where we are expecting that Fed decision to come at 2 p.m. and the summary of economic projections as well. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman coming up at 3 p.m. Eastern Time. There's also the special that we will have for all things Fed. Stay tuned.